Welcome back. It's time to talk about the capital asset pricing model. So in this video, I'm going to give you a brief background on the CAPM. I'll talk about the model and each of its components, and then we'll take a look at the relationship between beta and the expected return on a stock, say stock I. Okay, so the background on the CAPM, pretty straightforward. This is a model that was built in the 60s. There were multiple teams working on it and deriving it. And many people, Markowitz, Sharp, Lintner, Trainer, are credited with its development. The CAPM is the equilibrium model that underlies all of modern investment theory. It's closely tied to something called the fundamental pricing equation, which is well beyond the scope of this course. Now, the CAPM, developed in the 1960s, it was developed under the assumption that investors can build a diversified portfolio of securities using the modern portfolio theory. It assumes that firm-specific or diversifiable risk can be diversified away. So three financial economists, Bill Sharp, Jack Trainer, and John Lintner, typically these are considered the guys who are given the most credit for the model. They each worked on the project separately, and Bill Sharp and Harry Markowitz received the Nobel Prize in Economics in 1990, in part for their contributions to the development of this model and portfolio management in general. Now, the CAPM, it has many purposes. Since the model is used to calculate beta and can be used to calculate expected returns on stocks, we can use it in valuation models and when we need to calculate the weighted average cost of capital. Now, the CAPM makes a number of assumptions. This is by no means a complete list, what you're about to see, but you should know at least these assumptions. First, the CAPM assumes that markets are efficient and information is priced. This means that investors respond to new information by immediately factoring it into the share price. News that indicates cash flows of a stock will decline in the future should decrease the value of the stock. If the markets are efficient, that bad news will be reflected by an immediate decrease in the share price. Second, we assume that there are no taxes or transaction costs. In general, there are just no market frictions. Now, taxes and transaction costs can create market distortions. Some investors might hold securities for longer than they otherwise would if the long-term capital gains tax was lower than the short-term capital gains tax. Other investors might not buy or sell securities if the transaction costs were too high. As you're probably aware, this particular assumption of the CAPM does not hold up in the real world. In the real world, we do have market frictions. We do have taxes and we do have transaction costs. However, we need to make this assumption in order to be able to develop the CAPM and keep it from being much more complicated. Now, the final assumption that I want you to be familiar with is this one. The CAPM assumes that all investors have the same assets that they can invest in. This means that every investor around the world must be able to buy and short any security. This allows them to make use of their information, and it ensures that the stock's market price can fully reflect the intrinsic value of that stock's price. Now, in the real world, again, this assumption doesn't necessarily hold up. Investors from some countries aren't allowed to invest in other countries. For example, for a long time, U.S. investors were not allowed to purchase Class A shares of Chinese equities. That changed a couple of years ago, but it's just one of many examples. Another example might be that mutual funds are often only allowed to invest in stocks, bonds, and money market securities. They can't invest in a lot of more risky asset classes. Also, some investors are not allowed to short securities. Let me give you an example. In the Chinese market, Chinese citizens are not allowed to short Chinese stocks. There's an explanation for that, but I guess maybe a bit beyond the scope of this course. But we generally assume all of these to be true in order to ensure that the CAPM holds. But in the real world, really there's some issues with every single one of these assumptions. All right, now, here is our model form of the CAPM. This is the form that you saw in Finance 300. It's the form that we always talk about. It's our basic form of the CAPM that you should know, that you should have memorized already. But let's talk about this thing. What it says is that the expected return of a stock, let's call it stock I, is equal to the risk-free rate plus your stock's beta times the expected return on the market minus the risk-free rate. Now, we have proxies for every single one of these things. In the United States, typically we use a proxy for the risk-free rate. That's very often going to be the yield on either a 1-year T-bill or something like a 10-year T-note. In my opinion, the longer the maturity, the better for this risk-free rate. So maybe something like a 10-year T-note or a 20-year T-bond would be more appropriate. The beta, this is calculated using the other form of the market cap of the CAPM that I haven't gotten to. This is empirically calculated, and I'll show you how we do it later. The expected return on the market, this is essentially what we expect the broader market in the economy to offer in the next year. In the United States, we generally plug in the expected return on the S&P 500. Basically, our proxy for the market is the S&P 500, and this entire thing in these parentheses is what we call the market risk premium, which you should remember from our 4th week of lecture material. Now, I'm going to say it about as many times as I can before you have your exam on this topic, but easily the thing that trips the most students up in this class is understanding the difference between the market return and the market risk premium. Inevitably, half the students in this class will miss this question on the exam. Don't let it be you. Basically, this entire thing in the parentheses is our market risk premium. If I were to give you, let's say, the return on the S&P 500, you would just slot it right here and subtract from that the risk-free rate to get the market risk premium. Basically, what I'm trying to get at is the return on the market is not the same thing as the market risk premium. To get the premium, you have to subtract the risk-free rate. So that's that. Now, one final point here. What this model essentially says is that as the market does very well, stocks with high betas should have high expected returns. If we expect, let's say, a negative market risk premium for whatever reason, and stocks that have high betas should have negative expected returns. But in practice, generally we slot a number in here like 6%, 6.5%, or some people try to estimate this. All right, let's try a CFA question just to kind of test your knowledge on this topic. Which of the following is most likely to have an expected return less than the risk-free rate? An asset with a beta of negative 0.25, an asset with a beta of 0, an asset with a beta of 0.25. Oh, the correct answer here is A. Assets with betas that are negative will tend to have returns less than what the market offers. If I go back to the model form of the CAPM, when we have a negative beta, generally this is going to decrease this entire portion of the equation, and so our expected return on the stock is going to be lower than it otherwise would if we had any positive market risk. Okay, one more question here. Given that the expected market risk return is 7.5% and the risk-free rate is 4%, what is the expected return for Diana's security? We have 3 investors here, expected standard deviations given, betas given, and some dollar value or some other information just in terms of returns. What is the expected return? If you want to pause this and take a crack at it, feel free. I'm just going to give you the answer because you can pause it anyway. Correct answer here is 9.7%. So let's go through this. We start off with the CAPM, or the model form of the CAPM, and we plug in our risk-free rate, which is 4%. We know Diana's beta is 1.4, so that goes right there. And then our market risk premium is just our market return, or as the CFA would call it, the market risk return of 7.5%, minus 0.04 And this entire thing, this is our market risk premium inside the parentheses. So what we get is 9.7%. Okay, so now that I've talked through the basics of the CAPM, how can we use this thing? Well, this thing is used all over the field of finance. In valuation work, we use the CAPM to estimate the cost of equity in the weighted average cost of capital. Equity investors will typically demand a certain return, and we use the CAPM to estimate that. So if I'm an equity investor or a stock investor and I'm considering investing in a particular asset, the CAPM gives us a required return. It's required because I am requiring it, otherwise I'm going to sell my shares and go invest in something else. In capital budgeting, typically we use the CAPM to estimate a discount rate, and then in investment research, we'll use this CAPM all the time to try and predict expected stock returns. The CAPM is our fundamental basic model when it comes to predicting stock returns. Nowadays, though, as you'll see in later videos, the CAPM is it's a building block. More complicated, better models have been built on top of the CAPM model. Okay, final thing that I want to mention here, the security market line, or SML. Now, the SML is this line that shows a graphical interpretation of the CAPM. If you want to think about it this way, it's the picture of the CAPM. The SML, I just have a basic SML here. What it shows is the expected return for a given level of market risk, beta. So we plot it by starting at the risk-free rate. So let's say we have a risk-free rate or like a T-bill of 4%. And then as we increase the risk, we should see an increase in the expected return. So this point right here, where we have a beta of 1, an expected return of 10%, this represents a 6% risk premium, so 10% minus 4%. This thing it's not as important as you might think, but it's one of those definitions that you absolutely need to know. Certainly stepping into a job interview, if you don't know what the SML is, I worry about your prospects in investments. So this is just one of our most basic definitions when it comes to the CAPM. The SML, which is just a graphical interpretation of the relationship between beta and expected returns. Okay, let's summarize. The CAPM calculates the expected return of an asset based on that asset's beta. The CAPM, it assumes that there's only one driver of return, and that driver is the asset's market risk. And then finally, we talk about the SML, and that's just a graphical interpretation of the relationship between beta and expected return. All right, so with that, I'm going to bring this video to an end. If you have any questions, obviously, please feel free to reach out. Thank you.